Hello everyone, welcome you all to the investment management class. I am Impa Bilyappa, Associate Professor, Department of Management Sciences, Maharaja Institute of Technology, Mysore. Previously we have done the theory of Unit 3, which is the bond management strategies, bond valuation and bond duration. In today's class we will be discussing the preference shares and the concept, features and types of it, and we will be discussing the advantages and disadvantages of it, and we will be discussing equity shares, the concept, features, types and advantages and disadvantages, and then we will be discussing its valuation. Okay, how do we evaluate the shares? So in the previous class we learned how a bond valuation of we are going to do, like how we calculate the future value, the present value, and also how do we calculate the duration. All that we learned. Here it is different because that is a debt instrument and this is the shares which we are speaking about. So let's know the meaning of preference shares. So preference shares are, the name itself will tell, it is preference. They are giving preference. Preference in what? Preference in terms of dividend payment and also preference in terms of repayment of the capital whenever the company is liquidating or winding up. Okay, that's the reason we call it as preference shares. Here normally the dividend rate is fixed and the holders have the get the dividend even way before the equity shareholders. Okay, they don't have any kind of voting rights for this preference shares. So preference shares is where the shares will get a preference over the equity shareholders. Over all the rest of the shareholders, the preference shareholders get a preference related to dividend payment and also related to the capital repayment. And to know about the share, I have told you many a times, and that is not the basic, but even then a share is a share in the share capital of a company. So if a company need to start, a company is to be started, then you need capital for it, and to raise the capital, share is one of the form. In detail we have learnt it in unit 1. Okay, let's go on next with the features. Features of preference shares. Once the meaning is being derived, it is quite easy to tell the features, advantages and disadvantages of any concept. So now I have already told the meaning, we will split that and make into the features of preference shares. So features of preference shares will begin with dividend. Okay, like dividend, from rest of the shareholders, the preference shareholders will get the dividend first. That is one of the feature. And the dividend what they give, it is fixed, like 5% dividend, 10% dividend, how I explained in bonds. In the same way in preference shares also the dividend is fixed, the percentage of dividend is fixed. And third, this is also one of the form of long term finance, that is the capital finance, capital market instrument means long term finance. And next is dividend, it is like normally higher than the interest rate of debentures. Whatever bonds and debentures I have made, the dividend for preference shares is always higher. Okay, and they do not have any kind of voting rights, so there will not be a part of any kind of decision making of any particular company, and they will not have any right on the asset of that particular company at the time of liquidation. Okay, so these are certain features. And to include to this related to the par value of preference shares, it is normally issued at par, and they have primitive rights over dividend payment and capital repayment. Apart from that, they don't have any kind of preference towards that. Okay, and dividend is not tax deductible. So in case you invest in any kind of shares, preference shares, and you get dividend towards it, you cannot claim it for your tax deduction. It is not tax deductible, and more of it you can learn it in your taxation. Okay, and they have this hybrid security of preference shares because they bear some of the characteristics of debentures also. Whatever debentures we have, this is quite similar to that. The difference is that is the debt instrument and this is the share. That is the difference. So these are some of the features of preference shares. And let's move on to the next concept, which is the types of preference shares. So types of preference shares, you can segregate it according to the clauses like time of issue, okay, or else the dividend payment. Based on the different categories, you can segregate the types of issue. The first one will take on the basis of the dividend, like cumulative and non-cumulative. Okay. So what do you mean by this cumulative preference shares? So cumulative preference shares where the shareholders have the right to get the dividend even though there is no profit in the company. Suppose we will take an example. If this year the company is not making any profit, so automatically it means that there is no share for the there is no profit, or there is no dividend. In simple terms, there is no dividend for the shareholders. Okay. But in cumulative preference shares, even though the company is not having profit this year, then this year's dividend will get accumulated to the next year, and next year whenever the company is getting the profit need to be paid to the cumulative preference shareholders. Hopefully you have understood the concept. I will repeat once again. Whenever in cumulative preference shares, if the company does not have profit in the current year, the next year it will get accumulated, that is previous year's profit will get accumulated in the next year, and next year when the company has profit, the profit portion has to be, that is the dividend percentage, the dividend portion of a particular shareholder need to be paid to the shareholders. That is cumulative preference shares. And let's go on to the next one, which is non-cumulative preference shares. So it is vice versa of cumulative preference shares. So in this, if the current year you get profit, you pay the dividend. Next year you don't have profit, you are not accumulating anything, you are not paying anything. It is only being paid out of the net profits. Okay. Suppose this year you are in loss, you don't have any profit, you are not paying any dividend to the shareholder. Next year if you are having profit, then only the next year's dividend is being paid to the shareholders, and the previous year's dividend does not get accumulated, neither being paid. Okay. That is related to the cumulative and non-cumulative preference shares. The second category of types, that is based on voting rights. Okay, or based on participation. So there are two types, participating preference shares and non-participating preference shares. So let's discuss with the participating preference shares first. Here participating means participating on the surplus, participating, they have the right to participate on the surplus profits of the company. Whatever fixed percentage is there, that they get it, that is fixed percentage of dividend, that they get it. Along with the fixed percentage of dividend, they get the portion of profits, like how it is distributed among the equity shareholders. In the same way, the preference shares holders will also get the dividend. Okay, along with the stipulated rate, whichever rate is fixed, along with that they also will get the surplus profits of the company or the organization along with the equity shareholders. So this is participative preference shares. And next is you have non-participative preference shares. So non-participative preference shares means here they will be entitled only to get the fixed percentage of profit and not anything more. Okay, not anything extra. Like how in participating, whatever surplus profits are there, along with the equity shareholders, the preference shareholders will also get. But in non-participative preference shares, you will get only the stipulated or fixed percentage of dividend. Apart from that, you don't get anything extra. Okay, they don't have any right to participate in the extra or surplus profits. Okay. The next is based on convertibility. Okay, there are two types, convertible preference shares and non-convertible preference shares. To begin with the first one, which is convertible preference shares. Preference shares can be converted into equity shares at any specified rate or on the expiry of the stated period. For example, they'll say that 2 years your share will be treated as preference, and after that it will be treated as equity. Like whether the specified date is preferred, or it might be the specified date or rate, anything is fine. The equity shares are converted, the preference shares are converted into the equity shares. Okay, and this is known as convertible preference shares. Non-convertible preference shares, they cannot be converted into equity shares. It is only the non-convertible, means they have to be preference shares till it is redeemed, till it is mature. Okay, that is convertible and non-convertible. Next is based on redeemability. Based on redeemability, there are two types: redeemable preference shares and non-redeemable preference shares. In redeemable preference shares, normally it is repaid after a fixed period, okay, fixed term. Okay, here the shares can be redeemed or repaid after any fixed period. Before the even before that only the company can redeem. Suppose the preference shares are like for 10 years, 15 years, it is a long term and there is no particular period or date in which it will mature. But redeemable preference shares can be redeemed by the company on their own wish. They can call back and redeem the preference shares whenever the company feels that they have surplus profit or surplus cash. They can call back the shares and they can pay back the money. That is redeemable preference shares. Non-redeemable preference shares is where it is referred to the shares that cannot be redeemed through the lifetime of the company. Until the company exists, the shares will also exist. They cannot be redeemed. They cannot be called back by the company. Okay. The next is we'll move on to the advantages and disadvantages of preference shares. Advantages are like it is very easy to sell to the investors. Like if I am the investor and I am holding the preference shares, it is quite easy for me to market and sell the shares, means the liquidity is there. Okay, people would want to have safety instruments, and you get the regular fixed income, and we are at the mindset that our principal should be safe and we should be getting correct return time to time. That is our mindset. So if you are in that kind of mindset, this is quite safe in terms of shares. And then there is no obligation of dividend. For the company also, it is like if they have profits, they can pay. If they don't have profits, they need not pay the dividend. Only in case of cumulative, you need to pay the dividend mandatory, or else it is not that compulsion that you have to pay the dividend to the shareholders. And next is no interference. So preference shareholders does not have any kind of voting rights. So there will not be a kind of the decision making or ownership or control over the company. Their interference will be equal to nil, we can say. They will not interfere into the affairs of the business. And next is trading on equity. So the rate of dividend on preference shares, it is fixed. Okay, so once you get the fixed amount of dividend, so there are rise in the earnings, then the company need not provide more dividend to the person or to the shareholders. So if it is equity, they need to be paid more. But in case of preference, then only the fixed amount need to be paid, even though you have surplus profits. Okay, and then no charge on assets. I said no, they don't have any kind of ownership or control over any kind of asset. They don't hold any kind of asset even at the time of liquidity. So they do not create any kind of mortgage or charges on any particular asset of the company. They are free for raising loans in future. Okay. Next is flexibility. So the investors have the company, for example, I'll tell you in two prospects. So the company's prospects, like they can issue any kind of shares, like they have the flexibility, redeemable, irredeemable, if you want to pay it for the longer time, shorter duration, cumulative, non-cumulative. So there is no danger of over capitalization and the capital structure remains elastic. Okay, but in terms of investors, you get a wide variety of shares, like however you prefer. Based on your objective you can select. Suppose you want a cumulative share, you can buy. Suppose you want a redeemable share, you can buy. You have a lots of varieties according to the needs, according to the requirement of the shareholder, based on the objective also you can prefer. So depending, they don't put their preference over any voting rights or rights to conversion or special rights. They don't have anything like this. So they are simple neutral shareholders. Let's move on to the disadvantages. So disadvantages are like whatever advantages we have written, it is quite different from the disadvantages. Like disadvantages where the dividend is paid on a fixed rate. One is their advantage for the company, but they can give fixed percentage of dividend and they can keep quiet. But for investor here, if the profits are less of the company, it becomes an advantage. But if the profits are more of a company, then you get fixed amount of dividend, fixed percentage of dividend, which is a disadvantage for the shareholder. Okay, and then you have limited appeal, like they are not that bold and they don't have higher dividend of the higher rate. They might offer higher dividend, but they do not attract the investors because they are not get anything extra fixed. So either it might be debentures or preference, does not make a huge difference. Okay, low return. So in case the company is performing very well, I just now told, if the company is performing very well, then automatically they have to settle for lower dividend. So that is a disadvantage. Then no voting rights, so they cannot control any company, they are not treated as the owners of the company, so there is no voting rights. Okay. Next is fear of redemption. If you have purchased a redeemable preference shares, you have to always be conscious when the shares will be called back. So when the shares are called back for refund of money, then whenever it is not favorable, you have to give it back. You don't get anything, and you don't feel the need of investing. So automatically whenever the company calls back for the shares, you need to give. So always you will be having this fear of redemption. Okay, so now as of now we have discussed these concepts of preference shares, where we have discussed the concept, features, types, advantages and disadvantages. Okay, let's move on to the equity shares. Share is a share, but the difference is there is equity share and preference shares. So difference we'll discuss later, because I'll tell you the meaning of all meaning types and all of the equity shares too. Then we'll discuss what are the difference, why there is a difference, and what are the difference between preference shares and equity shares. To come with the concept of equity shares normally this is the main source of finance, and they are treated as the owners of the company, and it is issued to the general public. Okay, they don't have any preference related to dividend payment and capital repayment. After the debentures, bonds, debentures, preference shareholders, at the end equity shareholders will get the dividend, equity shareholders will get the capital at the time of liquidation. So these are see, owners means they have to bear all the kinds of risk and return. So that is the reason you are not paid at the beginning, you are paid at the end. Anything left over, onchur ulukondidre, the equity shareholders will get it. So here they enjoy the right to control the entire business, as they have the voting rights. Okay, they have the voting rights only in certain matters. They enjoy this benefit. Okay, that is the concept of equity shares. Let's discuss the features of equity shares. So features of equity shares are like, these are permanent in nature, so there is no further conversion in this. Like preference shares you can convert it into equity, but equity shares cannot be converted into any form. Okay, so equity shares shareholders are treated as the real owners of the company, they bear the highest risk compared to preference and debentures and bond holders. They bear the highest risk, and they are transferable. Whenever the ownership of equity is transferred with or without any consideration, it can be transferred to another person. Okay, and dividend payable, it is whatever profits left over after paying on to the debenture holders and preference shareholders, whatever profit is remaining, that is apportioned among the equity shareholders. Okay, as it is apportioned among the equity shareholders, the percentage of dividend which is being paid, it is not fixed. If you have got higher profits, then it is very beneficial, you can distribute more, you get more dividend. But if there is less profit, then you have to pay to everyone, and remaining less amount you get it. Okay, that is related to appropriation of dividend or appropriation of profit in the form of dividend. And they don't get fixed rate of dividend, I have told this, and they have the right to control all the company's affairs. And the liability of the shareholders to limited only to the extent of their investment. So, how much you have made an investment, the liability is restricted only to that particular amount, whatever you have made an investment. Suppose you make an investment of 10,000, then your liability is only up to 10,000. They don't come and take or seize your home, car, not assets. It is only limited up to your investment. Okay. Let's move on with the types of equity shares. Okay. Types of equity shares are like you can issue various types of shares. Like first is authorized. I have told you this at the time when explaining unit 1. Authorized share capital. Authorized share capital is the capital which is the highest amount an organization can issue through its lifetime. If they want to make any changes, then they have to follow the formalities or recommendations, make changes in their memorandum, then only they can extend the authorized share capital. Then comes the issued share capital. The entire amount of authorized capital will not be issued as a form of capital. Only a portion of it will be issued to the general public, and that is known as issued capital, where it is approved capital of the organization. Next is subscribed. How much ever we issue, the people will not subscribe. The portion of the issued capital is called where the investor accept and agree upon. They agree upon to buy, they agree upon to purchase. That we call it as issued capital. Then comes the paid up capital. Paid up capital is where in this section you can say that it is a portion of the subscribed capital. They have subscribed means the company has issued so much of capital and investor has accepted it, that is subscribed. Whereas here the investor has paid money to the organization, that is known as paid up capital. The investor has paid the capital to the company, so that is known as paid up capital. Then you have the bonus shares. Bonus shares is like when a business has a stock split. Okay, they want to have an more number of stocks in their basket. At that time the company issues bonus shares, and bonus shares are like free shares. Okay. Advantages of these bonus shares are like, for the company point of view, from the company point of view, whenever the bonus shares are issued, they do not involve any kind of outflow of cash. You do not pay any amount of cash, no outflow of cash, and and does not affect any on the liquidity position. Obviously, when there is no cash outflow, it will not have an impact on the liquidity position of the company. On another hand, if the bonus shares are like free of cost and their stake in the company increases, like if there was 10,000 and you split 1,000 shares into bonus shares, then by not paying anything, by not gaining anything, your 10,000 shares will become 11,000. It's just the existing stock will be split, and no inflow, no outflow. Okay, this is an advantage for the company, and disadvantage is like this will decrease the rate of return. For example, earlier it was divided only for 10,000 shareholders. Now it has to be divided to 11,000 shareholders. So what happens is your return, whatever it is there, that rate of return will decrease, and it will have an impact on the market price of the share. Automatically, when the rate of return decreases, the market price will also increase. So this will have an impact on the earning per share, because earning per share will also decrease. Okay, and this all can be made through the new issue market. So new issue market is where the first time the shares are being issued. It can be issued through prospectus to the public. Whenever you issue shares to the general public, then you have to make an issue through prospectus, and there are different set you will have, like different allotment will be made. First the application will be taken, then the allotment will be made, and the calls can be split into different, like first call, second call, final call, like that it can be split according to your requirement, and you can collect the money from the people. Okay, and the prospectus will contain like date of payment, amount of payment, what is the size of allotment, how much is the authorized capital, right issue, all these, like filling of the prospectus by the registrar of the company. Security Exchange Board of India, that is the SEBI, will have an approval for it, and you need a merchant banker for it. We are discussing in the concept of merchant banker. Okay, so these are the different ways through which you can issue the shares. Okay, so apart from these, like you have other issue like right issue. Okay, so right issue, what do you mean by right issue? Right issue is this, see, the bonus issue and right issue is quite similar, but bonus issue is for free, and whenever there is stock split you get a bonus issue. But right issue is where right issue is issued according to the articles of association. If it permits, then you can issue the rights issue. Rights issue are the shares which is being issued to the existing shareholders at a concessional rate. Okay, whoever the existing shareholders are there, for them the rights issue are offered at a concessional rate. That you have to pay attention. It is not free as bonus issue. It has been charged, but at a lesser price. So this type of issue is to preserve the proprietary rights, like they give more preference to the old customers, like how in shops, grocery shops or more and all, they give you the customer benefit card or membership cards, and for those members there will be special advantages for them, like in case of discount or free products, and they get special advantage. In the same way, in rights issue also, to keep the proprietary rights safe of the old investors, they make this rights issue. Okay, and rights issue can be computed like where the issue price of a new share is taken and number of old shares you have given, and based on that the right issue multiplies. Okay, advantages of this right issue is they do not affect any kind of controlling powers. Okay, it will be same. Flotation cost, brokerage, commission expenses are not incurred. It will be same. First only it will be incurred, so no extra cost will be there. And shareholders will also get a monetary benefit that they are getting at a concession rate. If reputed companies or blue chip companies make an issue, it is always advantages for the shareholders. Okay. Then disadvantages of this rights issue. If you have to tell the disadvantages of this right issue, then it fails to exercise the right of control within the stipulated time, and also the wealth will decline, because the same thing is being taken, the shares are taken for a concession rate, so the wealth will decline of the company, and this is due to the concessional rates. And one more kind of equity is there, that is known as the sweat equity. Okay, bonus issue, right issue, sweat equity, it is quite similar. Bonus issue issued for free, right issue it is issued at concessional rate. Sweat equity is an equity which is issued according to the Companies Act of 1956, section 79A, where the employees or directors of the company okay, they get the consideration other than cash. Instead of giving a cash recognition, they give this in the form of shares. So if we feel that any of the director or any of the technical person who is very much resourceful for the organization and you want to acknowledge him, then you give the sweat equity, and it can be made if it is authorized at the general meeting by a special resolution. First they have to pass a special resolution in the general meeting, then they have to approve. It is also governed by the sweat equity regulations of 2002 of the SEBI. Okay. If any of the worker has performed excellently, outstanding work, then the executives of the organizations for their extraordinary work, they get this. And so they give this because they want to keep their knowledge in the organization in order to protect the intellectual rights, intellectual property rights, their knowledge, the resources. They give this sweat issue. They make this sweat issue. Okay. Advantages of this sweat issue is it is not transferable within 3 years. After that they can do it from the date of their allotment. They have to keep it for 3 years. It is like another term of contract. It's not a contract, but it's like a contract. Okay. And they do not involve any flotation or brokerage cost. Disadvantages is it is issued again at a concessional rate, and there will be financial loss, and this will affect the liquidity too. Okay. And these are some of the types of equity shares. Let's move on to the advantages and disadvantages of equity shares. Okay. In the form of advantages related to shareholders' point of view, so it is there are chances of getting high return. Easy means liquidity is always there, people will be ready to buy your equity shares, and if there is high profit you get very good dividend, and they can have a control over the management in their decisions. And equity shareholders will get the benefit of two. One is the return, another one is the capital appreciation. Whenever it is traded in the stock market, obviously it will be trading at a higher rate, so they'll get that advantage too. And advantage for the company point of view, it is a permanent source of capital, it is a long term source of capital, and they do not have any kind of obligation related to the payment of dividend. If they have profits, they make the payment. If they don't have profits, there is no compulsion. So there is nothing like cumulative profit and all, only in preference shares you have that. So there is no compulsion of paying the dividend, and equity capital base will increase the credit worthiness of the among the creditors and investors. So that is a kind of building the trust, okay, towards the shareholders. And coming to the disadvantages of equity shareholders, like from the shareholders point of view, so it is very uncertain. You may get profit, you may not get profit, so you cannot assure you will get profit, and sometimes you will not be able to exercise your right. Like even though you can control the management of the company, sometimes if you are a petty investor and all, as the investors pool is very scattered and unorganized, and you will not be knowing who is the owner of that particular, that is other shareholders of the particular company, then it is very difficult for you to have an overall authority or control towards that particular company. And yeah, it is also risky, because at the time of liquidation, if the company is in loss, then you need to pay to the debentures and preference. At last you may get your fund back or may not get your fund back. So that risk is also there, and it will always be very fluctuating. Whatever happens in the market will have direct impact on the shares. So the value of investment may sometimes become neutral. And other than this disadvantages, yeah, issue of fresh shares, so reduces the earning of the existing shareholders. As the fresh shares are extended, if the company is going to issue more number of shares, then automatically the existing shareholders, their percentage of profit will come down, because earlier it was been divided only to 10,000, now it will be divided into 20,000. So automatically whatever return you are getting, that will reduce. Okay, then disadvantages in terms of company point of view. So here it is highest among the sources of finance, it is huge capital, payment need to be whatever payment is being made in the form of dividend, that is not tax deductible, and they have higher flotation expenses, brokerages, underwriting commission, all this will be more. So these are certain advantages and disadvantages of the advantages and disadvantages of equity shares. So now we will have a comparison of this preference shares and equity shareholders. So preference shares, you have fixed dividend, equity you have fluctuations, voting rights is there in preference, and so voting right is not there in preference, there is voting rights in equity. And participation, there is they have limited participation in any management decisions because they don't have any voting rights, and they whatever surplus is there, that has also not been distributed. Equity shareholders have the right of participation in the decision making and all. Okay, always in the payment of dividend and capital, preference shares have the preference, whereas equity shareholders do not have any kind of preference. Let's move on to the last topic, which is valuation of securities. So valuation of securities can be done in three ways, that is based on the balance sheet, based on the dividend distributed, and other approaches. Based on the balance sheet, you have book value, liquidation value, replacement value. Based on the dividends, you have 1 year holding, multiple year holding, constant growth molding, multiple growth molding, and in other approaches you have a price to book, earning multiplier approach, price to sales ratio, and market value method. Okay, so these are the different ways. So start with the based on the balance sheet, you have three, as I have said. Book value. Book value is where the net worth of the company is divided into number of outstanding shares, and it is equal to the paid up capital plus reserves and minus losses. Okay, plus reserves and surplus minus losses, that is the based on book value. So if you just refer a balance sheet, then you can value on the basis of the book value. Then liquidation value. Liquidation value is value of an asset at liquidation. It is often where in the market it and sometimes in the book. Okay, it is less than the market and book value. The valuation is based on asset at liquidation. Okay, liabilities are deducted from the liquidation value of asset and determine the liquidation value of the business, that is liquidation value. Replacement cost. Replacement cost or current cost of an asset is the amount of money required to replace that particular asset or similar asset, okay, with identical features or service or capabilities. That will the cost of replacing what it is there, that we call it as replacement cost. And then you have that is based on dividends. In this set we have problems. Okay, 1 year holding dividend means you have to hold it for 1 year, and after that you can sell. So purchase, you have to hold it for 1 year and then you can sell. So they would receive dividends as well as the share price at the end of 1 year. So for this we need to calculate present dividend value first of the expected cash flows. We need current price, dividend, required rate of return, and price. When we do the problems, I will let you know. Okay. Then next is multiple year holding period. Multiple year holding period is they have to hold it for a several number of years, certain number of years, 2 years, 3 years, like this they have to hold the share, and the dividends for these periods and market share price will be gained. Okay. So the meaning itself will tell you. Okay. Next is constant growth model. Here dividends will grow at the same rate, there is no fluctuations for an indefinite period, maybe 5 years, 10 years, the period is not specified, and there is discount rate which is greater than the growth rate. So discount rate is normally higher than the growth rate. And then you have multiple growth model. Here growth of dividend will be at different levels. So whatever dividend you get, that will be growing, divisible. Okay, maybe 5%, 2%, 3%, there will be raise in it and or less in it to an extraordinary growth period. Okay, that is multiple growth model. Okay, and you have problems on this too, very important. Okay, next is the third category, which is other approaches. Other approaches is like price to book value ratio, where the book value of the company will value the net assets in the balance sheet, and net assets what we get, that is total assets minus intangible assets and liabilities. So the ratio given is how much it is actually paid for the share, that is the price to book value, means price of an asset is taken in order to match the book value. Okay, that was the price to assets value ratio. Next is earning multiplier approach. Earning multiplier approach is where the value of the equity share is estimated, okay, by using a formula P naught is equal to EPS into price earning ratio. And the third one is price to sales ratio. Price to sales ratio is where it is dividing the company's current stock price by its revenue per share for the recent 12 months. They will take the data of the recent 12 months and divide the company's stock price with the revenue per share. Okay, how much the market is willing to pay the return of the rupee for the sales, that we can understand by using price to sales ratio. Price and sales is compared. Okay. Next is market value method. Market value method, where this is possible only in case of listed companies because they have certain market value. They multiply the number of outstanding shares and market price, that is nothing but market capitalization. Okay. So this concludes the theory of unit 3, and you have dividend valuation models, as I have said, constant growth model, two-stage model, multi-stage model and H model, which we have already discussed. That problems we will be doing later. Okay. So what we have discussed in today's class, let's sum up. We have discussed preference shares, the concept, features, types and advantages and disadvantages. We have discussed equity shares, the concept, features, types and advantages and disadvantages, and we also learned the theory of valuation of securities. Problems, will be doing it in the next class. Thank you for attending the class.